Well, good morning, everybody. This is Michael Douville coming to you from the beautiful studios of West USA here in sunny Phoenix. Dave Ellefson is with us today, and he's going to talk a little bit about his foundation and some of the investing that he's done. But first off, I want to just spend a couple of minutes just going over this first slide because I sent this slide to you because there's so much turmoil and fear into the marketplace that I thought this would catch your eye and you'd get the gist of this. If you've been coming to my seminars and my podcasts, if you've been following, I know a lot of you have been talking to me privately. We've been talking about this risk that's entered into the marketplace, both in the stock market and in the bond market, and of course into the economy. This is unfolding exactly as our forecast has indicated. So we've been expecting this. So if you've been following us, now I know I haven't been doing enough classes. I get a lot of requests for classes, but I just haven't been out enough. But you know that we've been talking about building up reserves, getting out of debt, getting your cash together, making sure that your credit lines are in good shape. And risk has entered into the marketplace. This should not come as a surprise to anyone. Now, we're all going to come through this. You know, you don't get to be my age and not see this before. So I know it's going to be kind of scary, but right behind us, this is exactly on our forecast. We've been talking about this for the last 12 or 18 months, that right behind this is the explosive phase, and everyone is going to do really, really well. I know when I talk to a lot of agents, they talk to me privately and say, look at, I haven't put enough money away for retirement. I haven't put enough money away and gotten a cash stream for myself. I don't have an income stream for myself. Well, I'm going to tell you, you're going to have an opportunity to cure all of that. So I just want to go over this really quick. This is not a definitive graph, but I do want to go over this. We're going to talk a little bit about this. This is a double dip cycle from the 18-month cycle. Now there's two. We've talked about this in my seminars. This is kind of a rare event that's going to be taking place, is that we're actually going to get a double dip correction. This is very, very similar to the 80-82 correction, and right behind that, the economy took off. So I'm really, really expecting this to go. You can see where we are. We're just going to go down a little bit. This is going to be a correction in an ongoing bull market. This is not a crash in the real estate market by any means. This is going to give you an opportunity to make income for yourself, to get your IRAs, get your retirement in place, and we're all going to be fine. Now, I'm going to be available for you, and I know that if you want to talk to me privately, we certainly can. But in the meantime, a friend of mine, Dave Ellefson, is with us. And Dave Ellefson has been a friend and a client of mine for a number of years. And you're always good to get someone else's thoughts on this. And we brought Dave in. And Dave, good to see you. Thank you so much for joining us this morning.
Yeah, Michael, thank you so much for having me, and good morning, everybody. I hope everybody's safe and sound and enjoying their lockdown. Yeah, Michael had asked me, he's been asking me actually for a while to jump in on a seminar. And it's funny how these webinars, I do these every day now on Zoom in some way, shape, or form, especially stuff now with my David Ellefson Youth Music Foundation, which I'll get to in a minute. But just to speak to, I think, kind of the first, maybe a bit of a testimonial to what Michael's been talking about. I've been in the stock market probably since, I guess, about 1993. A business manager that worked for Megadeth had gotten us in with a Morgan Stanley guy, and initially it was okay. But then the first big, I think the .com boom was the first time I watched my portfolio ramp up, only to just completely, retract and go backwards. I rode that wave out again for another till, I guess, 2008. And it's funny, my wife Julie, she had an instinct in 2008. She said, we had moved our money to a Smith Barney guy here in town, our IRA accounts and stuff. And she said, we need to get out of the market. And the guy came to our house and said, please pull us out of the market. I said, oh, no, we're in for the long haul. Sure enough, literally the next day, the market crashed. And after riding that wave for 20 years and literally making no money and just sitting here going, there's no way me and Julie are going to be able to retire playing this game. And as a dear friend of mine who's also in real estate once told me, he said, I feel like the stock market is an insider's game that I'm not on the inside of. And I don't want to put my money anywhere that I don't have control or be on the inside of what's happening with my money. And, I've been in rock and roll my whole life. I grew up on a farm in Minnesota. Some of that family farm it's a centennial farm since the 1800s. Some of it by good management of my family over the years. I'm a fourth generation Ellefson, and a couple hundred acres of that land fell over to me by way of inheritance. Thank goodness, because it has added to my real estate portfolio. But that was just through good fortune and really through no doing of my own. What has been directed by Michael, one day, my father always told me, he said, David, you make your living in a very risky business, being in the music business. So you need to invest very conservatively. And I always remembered that because my income has come and gone. And like a lot of professional musicians, entertainers, athletes, I've had years with big windfall followed by 3 or 4 years with not much at all. And I've learned that I've had to save my money for a rainy day, because just like farming, rainy days come in the entertainment business. In fact, we're in one right now. The touring business is in a complete shambles. The goal of our touring business is to put as many people into big rooms as possible to make as much money as we can. And as we know, we are living in a time right now where any gathering of even more than a couple of people is strictly forbidden. So the future of the touring business is in it's very precarious right now. But how that plays to my current standing in my portfolio, I guess about 4 years ago, I woke up one day and I was sitting at breakfast with my wife, Julie, and I just said, we've got to get out of the stock market. And I've heard about this thing that a company here in Phoenix called Vantage offers, which is the self-directed IRA, self-directed IRA, where you can move your money into a holding tank, essentially, that allows you to invest your IRA money into other things besides stocks and bonds, particularly real estate. And Julie, we had to talk about it. Literally a couple of days later, she comes home from yoga class and says, oh my gosh, I just met a woman in the yoga class, and her husband does exactly what you're talking about. Well, that person is Michael Douville. Michael and I connected. I gave him the status of my portfolio at that time, and he quickly, I moved him our money via Vantage I liquidated it, got everything completely out of the stock market. And Michael began, he initially invested my money into 2 condominiums in South Scottsdale. Not the greatest part of town, but he did the research on the products. I purchased them. 2 years later, I sold them and doubled my money. I've just taken that money and now purchased a single family home. And my wife has a condo that Michael helped her buy. And Michael was good at helping us buy distressed properties that were completely vetted and ready to purchase. And I had to use a bit of a leap of faith. I kind of had to just go on it and trust Michael's instincts. And that property now for Julie has almost doubled in value. And so both of our portfolios have more than doubled just in the last 4 years. And additionally, I began to use the savings strategy of pay myself first. So as I would set aside any tax withholdings, I'd set aside a little tithe for church. I would also set aside at least 10 to 20% for me. And I would start, just like in order to be charitable, you kind of have to give till it hurts. The same thing I found to be true with savings. I had to start saving till it hurt. And the saving was always to my benefit, moving it from a cash account to a savings account and just essentially moving that money out of sight, and with the strategy that it would be available to buy more real estate properties. And Michael helped us buy a bank-owned property that is probably, I don't know what the value of it is, but it's I think we bought it at 163. I think it last appraised at 240,000. There's a very small mortgage on it, and has been rented since we purchased it. And essentially, Michael said the goal is to have 10 properties. That's the golden number. And right now I have a total of 8, including my primary residence, which is now paid off. And at age 55, it became very clear to me through some other brothers of mine in the church and whatnot that quoted the scripture of, the lender owns the lendee, and to get debt free. And so I can honestly say that I am completely debt free. My primary residence is owned. I have obviously the farm properties, which were a free gift to me, but through the 3 properties that Michael has helped me own, and now cash reserves to be able to buy another one, which I'm actually waiting to do now. And this, as we kind of watch this market flesh out, Michael has advised I have strategy, cash on hand ready to purchase. So my net worth has more than doubled. And I'm not going to lie, everybody, I sleep really good right now. When people talk about the stock market, I pay no attention because I'm not in it. I mean, I'm in it maybe 15, 20 grand, but it's nothing.
Well, isn't that the strategy? Isn't that the strategy?
Yeah, for the first time in my life, everybody, I'm sleeping really good. I now know what they're saying about you sleep much better in a house that's paid for. And all the, to me, just the nonsense of the stock market. It's just, my career and I'm a musician and a writer, a producer, and a performer. I'm not an aficionado in the stock market, and I may as well take my money and go to Vegas as be in the stock market. So I'm glad I'm out of that. And Michael, thank you for giving me a real strategy, and it's the strategy that he talks about here in this, and this is not a paid endorsement. This is just an honest from a friend, and Michael he's been a miracle worker for my financial portfolio for my family.
Well, thank you, David. That was a nice endorsement. Thank you for that. I didn't expect that, but this has really been yourself. You've been doing this. You have been very disciplined on getting this done. And of course, we keep talking about the fact that we need income no matter what you do, because we all have our business ebbs and flows. The economy ebbs and flows. You have things that are totally outside your control. And it's nice to have that income coming in each and every month. We just want to be very, very conservative. And, with you, I know you just came off a tour with Five Finger Death Punch, and now you're home. So you called me the other day, and I want to talk about your new foundation. That is so terribly cool. So,
yeah, thank you, Michael. Thank you. Yeah, one of the things that my goal, when your virtue, if you will, or becomes your vocation, suddenly it doesn't seem so virtuous anymore, and I guess that would be, for me to be a musician. There comes a point, obviously, when you're young, where suddenly the thing that became your hobby and your passion suddenly becomes the way to make your living, and it can steal your joy from it. So my goal in my 50s was, I'm very blessed that I've been able to have this long of a career, especially with one band, as well as all the other things that I'm involved in. But my goal was to be in a position where I can just dedicate my life full time to any endeavors in music, and not always have to do them for profit motive. And one of those is the David Ellefson Youth Music Foundation. At a point in my life where I find the joy of giving back. I'm partnered in with the Grammys, with the Grammy Music Education Coalition. And the goal of my foundation is to bolster and to continue to support music education programs, both in schools and out of public schools, and in particular in the rural areas, like where I grew up on the farming area of Jackson, Minnesota. Usually when cuts come to school budgets, they happen in the music and the arts. And I wouldn't be here having this conversation today if it weren't for the public school system and their music and art program, which is where I got my start. So we launched an initiative about 3 weeks ago called Schools Out. And we did that because suddenly schools were being closed all around the country and all around the world with the COVID-19 pandemic. And the goal is for me to start to give some music lessons privately, one-on-one, through a forum just like this, using Zoom and webinar and Cisco's WebEx platforms, to bring one-on-one music education directly to the students who are out of school. And so I called a bunch of my famous rock star buddies and musicians who are also off tour, of course, right now, and said, hey, would you mind giving of a little of yourself to some charity? And they unanimously all stood up and said, sure, we'd love to. And so now we have an incredible initiative called Schools Out. And I think it's going to last far beyond this pandemic. We don't know how long this is going to last, of course, but I think, these online platforms like we're doing right now in GoToWebinar, these are now going to become just as vital for all of our businesses as face-to-face meetings are. And so I think through crisis, sometimes we find opportunity. And this is one of these where the foundation is in place now to do it. We are taking donations. We started a fundraiser. If you go to the Ellefson Youth Music Foundation.org, so that's Ellefson Youth Music Foundation.org, there is a donate button right there. And I actually realized in foundation, I didn't put an N in there, I think, when I said that to Michael. I apologize. But Ellefson Youth Music Foundation.org, or that PayPal you see, Ellefson Youth Foundation at gmail.com. You can give tax-free donations because we are an Arizona 501c3 nonprofit. So there will be a tax advantage to you for that donation. So
how fun would that be, David? I mean, so you're talking about a high school child. It's maybe 15, 16 years old that's aspiring to play an instrument, and say they're playing a bass guitar, and they can have Dave Ellefson teach them how to play bass guitar. I mean, what a thrill that would be for a kid.
Yeah, thank you. I mean, I figured if Gene Simmons or some of my idols, whatever, Geddy Lee from Rush would do that for me, I'd be thrilled, So I think it's, our world is more connected than ever. Social media brings sort of celebrity figures into a more human element. And I think in this moment right now in the world when charity of all sorts is needed, I find that the charitable mind keeps the troubled mind out of trouble. And that goes for all of us. We can sit around and we can become naysayers and get negative with this whole thing that's going on. We're in lockdown, all of us, and on some level. And I think the more we can just give and get out of our woe is me, self-pity elements of our lifestyles being altered right now, the more we can give and be charitable, the better it is. So I appreciate anybody who makes a contribution. I'll just thank you in advance. And thank you, Michael, for inviting me to the webinar. I appreciate it.
Oh, well, kudos to you, David. Just think of all the parents that have their kids at home. This gives them something to do. Plus, music is such a great thing for kids. It builds character. It's been proven that they do better in school when they're doing music. And of course, you've got some of your friends. I think you mentioned that Alice Cooper is involved on this, and I think Kiko is involved. So can you just really tell some of the people who else are involved? I think you mentioned some of your corporate sponsors too are involved, are they not? It's going to be a pretty big deal.
Sure. Yep. Like I say, we're partnering. We're part of the Grammy Music Education Coalition. We've also got a technology sponsorship from Cisco, as well as Dolby. And some of the people that my buddies, drummer and guitar player from Megadeth, Dirk and Kiko, Frank Bello from Anthrax. Ron Thal, who was formerly in Guns N' Roses, Chris Cale from Five Finger Death Punch.
Wow.
Boy, the list goes on and on. Shania Kimmelman, who is a guitar player in the Michael Jackson One Experience by Circus Soleil over in Las Vegas. Of course, those productions have all been shut down and everybody's furloughed right now until Vegas opens up again. So she's a fantastic player from Israel, actually. So she's a fantastic player. And Jeff Duncan from Armored Saints, and boy, the list goes on and on. Nita Strauss from Alice Cooper's band. So it's really great. We're actually going to be doing a web telethon Saturday, April 11th, which is Easter Saturday. We are going to be doing our first ever fundraising telethon, and we're going to have a handful of those same people join us for performances, as well as comedians Don Jameson, Craig Gass, and Jim Florentine. So we're going to do, I think it's going to be an 8 or a 10-hour live telethon that's going to broadcast across the Grammys, the Music Education, their Twitch platform, as well as Facebook, and on my David Ellefson Facebook and YouTube, as well as the Ellefson Youth Foundation Facebook and YouTube. So if anybody wants to stop in, and if you're kicking it around the house, which you might be on an Easter Saturday of April 11th, feel free to stop in and hang out with all of us doing our fundraising telethon.
Well, David, thank you very much for this. I will do whatever I can to help you. Just sign me on. I'm certainly going to make a donation to you. Also, I'll make a donation of my ebook, which is available on Amazon for $10, but we'll make it available free to anybody who will, the first 100 people that will donate to Dave Ellefson's foundation. I'll make sure we email that over to you so that you can read it. It's a pretty easy read. Make sure now it's Ellefson Youth Foundation. And David, I didn't check this either when you sent that over. A foundation that does have FOUN Foundation, so we'll get that corrected and get that sent out so we can go ahead and make sure it's done. David, I know you have another. I know you have another interview coming up. Thank you so very much for taking your time to come up on here and at least share your thoughts. I know a lot of people really appreciate that because there are ways that we can go ahead and insulate ourselves and bulletproof ourselves to virtually anything that happens in the economy, and our life will just move on. And you certainly are a poster child for it. Thank you so very much for coming on. And if I can help in any way, just put me down on your foundation. I'll sign me up. I'm here to help.
I appreciate it, Michael. Thank you. Thank you so much. Goodbye, everybody. Have a wonderful day.
Thanks, David. See you later, man.
Yeah.
Bye-bye.
Bye-bye.
Okay, guys. So that was Dave Ellefson. I've known him for a lot of years, and you think he's a rock star, but he's also a father. He's also a husband. They have the same type of things that we do, and he's always concerned about money. So what we want to do is bulletproof our portfolios so that no matter what happens to our economy, our life goes on uninterrupted. And I talked to a lot of, I'm very fortunate, in my previous life as a broker, I had a lot of time because I put together a portfolio for myself that paid for all my bills. I've had an exceptional life. I'm not here to brag. I'm here to inspire you. And I wrote for Wall Street for a while. I have interviewed Charles Nenner many, many times. And of course, he sends me some of his data. So this form that you're looking at right now is just recently sent from Charles Nenner. So what I want to tell you is that this is his form, and we've had some concerns going on with the stock market. I know a lot of people are in the stock market, they're in the bond market. We've talked about the fact that there is risk in all of these markets. We've also been talking about the economy. I've been seeing it slow down really since March of 2018. It has been a slow slide. Last year, we saw in September when the repo market started coming across, and you saw that the banks were taking $25 billion, then it went up to $50 billion, then it went up to $100 billion. We had a interest rate inversion, and of course, those are all tells that things were coming. Now, if you went to the seminar we had in January, we were very concerned about the economy. We were very concerned about the stock market. We were very, very concerned about the bond market. And the bond market really is where the problem lies. Now, Charles Nenner just sent this chart to me. And what this chart shows is that the S&P probably will not bottom until late April. And then maybe it's going to start rolling over for a little bit. Now, I'm going to tell you this, you need to talk to your financial professionals because although I'm pretty well versed in it, I don't know each one of yours position, what your goals are, what your income coming in is for yourself. So what you want to do is talk to your financial professional and get them involved in your life. Now, I'm more than happy to discuss whatever it is that is on your mind. I'm more than happy to help with this. But this chart is showing that Charles Nenner believes that the S&P probably is not going to bottom for another 3 or 4 weeks. Now, in a bear market, which I think we can pretty well say we're in a bear market now, oftentimes you have many opportunities with which to get out of the bear market or to get out of the market. You can go ahead and trim your portfolio. You need to talk to your professional about that as to what's prudent for you. But there's lots of rallies, and you can have some pretty strong rallies within a bear market. Now, you've just noticed that in the last couple of weeks. I'm going to guess that we probably have another leg coming down. I don't think we're quite out of the woods with this. I think we probably will have maybe another 3 or 4 months out of this. I think we probably, now this is a typical recession. When you get to be my age, we've seen this before, man. So it's going to be scary. It's going to be worrisome. You're going to have some sleepless nights on it. But let me tell you, we're all going to come through this, and we're all going to come through it fine. And we're going to have some great opportunities for it. You need to preserve your capital, though. Now, when you're in the stock market, you need to talk to your financial professional and review your portfolio as to what's best for yourself. Now, you're going to have some exit points that are going to come along here, and you need to know whether it's a good one for you to go ahead and take a look at. So the real problem is in the bond market. Now, we've been talking about this for a really, really long time. I'm going to pick on Boeing. Boeing is one of the big Dow components. They have borrowed $100 billion. And with that $100 billion, they have bought back their stock. Now, they didn't build plants. They didn't invest a lot of this money. That was what they call a corporate buyback. I'm going to tell you that right now you can pretty well kiss corporate buybacks goodbye. And of course, corporate buybacks in the stock market were responsible for upwards of 70% of the raise in the S&P has been corporate buybacks. So that component of the marketplace is gone. So I don't see us having that big demand. So the corporate buybacks put kind of like a floor underneath the markets, underneath the stock market, and they use debt to do that. They use leverage. And that's just fine when business is running just wonderful. But when you get into these hiccups like we have now, they have a huge debt burden. Just put yourself in with yourself in your own household. You go out and borrow just tons and tons of money, and eventually you have to pay it back. Well, while you have all this money that you're borrowing, you can live life large. But until we slow down and you have to start paying this stuff back, now all of a sudden you've got a problem. And that's what's happening in the stock market. You're going to see that we have over $1.5 trillion of corporate debt that's at triple B. Now, triple B is one notch above junk. One notch above junk. Triple B. Now, you just saw a couple weeks ago that Ford Motor Company got downgraded to junk. So you're going to look at this. When this happens, if you're in the bond market and one of your companies gets downgraded, you're going to see that your portfolio takes a pretty big hit because the value of those bonds drops like a rock. And of course, those companies like Boeing, once they start losing that credit rating, they're going to have to spend a lot more money on interest because risk has risen. Now, when you see risk rising into the marketplace, anyone lending money wants to get compensated for that risk that they're running, and they want higher interest rates. So in the corporate bond market, we're going to start seeing a bifurcated bond market where anyone that has any kind of risk, they're going to have to start paying for that risk that's being run. So corporations are going to start seeing higher interest rates. Now, conversely, on the other side of it, the safest investment in the entire world is U.S. Treasuries. And if you're concerned about saving your money and keeping your capital safe, you're going to be looking at going into U.S. Treasuries. That's why you see U.S. Treasuries under 1%. In my lifetime, I never thought I would see a 10-year Treasury be less than 1%. And I think today it's down about 0.6%. So you can see these treasuries get very, very cheap. So we're going to see two different spectrums. You're going to see the U.S. treasuries getting lower, and at the same time, we're going to see interest rates go higher for corporations. So where does that leave us in the real estate business? So we don't follow the treasuries. We follow the agencies, which is the Fannie Mae, the Freddie Macs, and the Ginnie Maes. Those have the implicit guarantee of the U.S. Government, but they don't have the absolute guarantee of the U.S. government. So the Ginnie Maes and the Fannie Maes and the Freddie Macs, those are much higher interest rates. Now, if you notice the last 2 or 3 weeks ago, there was a huge spike in interest rates. We went from the low 3s on mortgage rates, and they jumped up into the 4s. That was because we just did not know what kind of risk was going to go into the mortgage-backed securities, which is what the Ginnie Maes and Fannie Maes and the Freddie Macs are. Now, the government's come in and said they're going to buy the mortgage-backed securities, and you've seen interest rates come down. So I'm anticipating interest rates are going to come down, and we're going to have a pool of money. But you need to look at your portfolio. Keep in mind, I'm a baby boomer, so a lot of it, we're very, very conservative. And people used to say, well, if you're conservative, you're in bonds. Well, I'm going to tell you, if you're in bonds today, that's not so conservative. We've been talking about the risk rising in the stock market. It is rising even stronger in the bond market. And you need to talk to your clients. You need to talk to yourself, talk to your financial professional, and see what kind of risk that you're really running on this. So This is where we're talking about now. This is just the Ginnie Mae. I shot this on yesterday. Do you see the spike down on that? That's the mid 19th of March, 3/19 of 20. So that's where interest rates spiked down. That's where you saw interest rates go back up to 4. And literally, they've come back, and now we're going into record territory, and interest rates are coming down. So I'm anticipating the fact that we're going to have lower interest rates in a mortgage-backed security. However, I'm going to tell you, it doesn't matter for interest rates. I don't really care if they're 5 or 10%. What's going to happen is that people get confident. They think if my business is doing well, and if I buy this asset and this asset goes up 50%, I'm willing to pay 10 or 20% because I'm going to make 50%. So right at the moment, that confidence probably is not in the marketplace at this time. But that's where we come as investors. This is where we're going to make money. I'm not necessarily looking for the fact that the interest rates are going to tumble and things are going to get really good. I'm concerned that we have a little bit of a hiccup in the economy, and we're all going to get through that. So I've talked about repositioning your mortgages, or I'm sorry, not your mortgages, but your portfolios. Now, no matter what you do, you're going to have regrets. So if you go ahead and talk to your financial professional and you say, look, I want to sell some of my positions and get liquid and get some cash up. Well, I'm going to tell you, if you do that and the market goes up, you're going to regret the fact that you did that. Or if the market goes down, you're going to say, I should have sold more. So no matter what you do, you're going to have some regrets. So just get that mindset straight so that you know that we're in a position of flux. So this may not be the very best time for you to be changing your portfolio, but it's probably not the worst time. So please talk to your spouse, talk to your financial advisor, talk to your brokers, talk to anyone that's handling some of your finances. I'll make myself available. You're more than happy to brainstorm with me. But it would be a good time for you to just start realizing what kind of investment exposure I'm taking and what kind of risk I am doing right now. So I fully expect rates. This is another chart I got from Charles Nenner. I think right now, if you are looking at the chart, you're going to see that we're getting to a kind of a low point for this year. I'm thinking April to May is probably going to be the low part for interest rates. Now, I'm not expecting them to skyrocket. You can see where they come up a little bit. And later in the year, as we go towards 2021, I think rates will go even lower. In my seminar, we talked, could we possibly get negative interest rates? And I said, yes. Well, we already have negative interest rates, that the 1 month and the 3 month treasuries are already slightly negative. So there's a lot of fear in the marketplace. I would say to you at this point that if you have a HELOC, if you have some kind of credit line that you have available to you, take that money now. If you've got available to get $100,000 or $200,000 or $300,000, take that money now, put it somewhere safe. Take that money now. I'm not talking about taking it tomorrow. I'm talking about taking it today. If you have some properties that you want to have ability to refinance, I would say do that now. Lock the rates in. Talk to your mortgage professional that you do business with, and ask him about refinancing and taking some cash. Now, this is investment cash for yourself. This is not money for you to go out and buy a motor home or go buy a brand new boat or go remodel the kitchen. This is strictly for your future, because we're going to have a buying opportunity that's coming to us, and you need to do certain things. One of the things that you absolutely positively need is capital to deploy, and we need to have that money and have that money now. So I'm going to tell you that the banks still are viable. But my experience in the past was, as the economy started to slow and the realization that maybe it's worse than what they originally thought, they don't want to lend the money. And the joke in the lending business is, when it rains, they don't want to give you an umbrella. So take your money now. Don't spend that money. If I find out you spend it, I'm going to come and beat you about the head and shoulders myself. This is strictly for investment money. So talk to it. Let's get that done. Let's get that done now. So the ability to have cash or the ability to raise cash is going to allow you to buy. We are going to have an opportunity looking us in the face within probably 3 or 4 months. Now, that I'm expecting that to go maybe another 12 or 18 months. Now, Dr. Nenner, we sent out his housing. We did a video on that. We did a podcast on it. Dr. Nenner sent me his housing chart, and it looks like we're probably slowed down until maybe the third quarter, fourth quarter of this year, and that's where I'm anticipating at the bottom. Now, if you've been following my charts, you know that I have a timing model chart. The timing model chart has been absolutely deadly accurate. Now, on my chart, I saw a spike. Now, I sell real estate. I am not a cycle researcher. Charles Nenner is probably one of the best in the world, and he told me what you're looking at is a double dip, and so that's what we have. We have a double dip correction. It is a correction in an ongoing bull market in our real estate business. So even though things may slow down and it may get a little scary, my charts are showing us that we're probably going to be looking at much, much higher prices in 2 or 3 or 4 years from now. So if you've been to my seminars, you know that my timing model shows us at 2023, 2024. That's where we're looking to accumulate our properties for that event. That is our target for this. So we're going to take a really close look at when we get to 2023, 2024, and we're going to start thinking, what are we going to do with this portfolio? So take your lines of credit now. Do your refinance now. And I'm going to tell you, you need to protect your credit. Make sure that you're paying your bills. Pay them early. Pay them as agreed. Get rid of all those little nuisance debts that we have. This is not the time to be buying a new car. This is the time to be downsizing. This is a time to be conservative. Protect that income. You know, if someone wants to do a rental and say, oh my gosh, I just don't want to do that, now's the time to go do that. Get that extra income coming in. And if you don't think that you're bringing in enough income, go deliver pizzas, go deliver food, go stock shelves. There is nothing wrong with doing honest work. You know, when I came out here and I had problems when I first came out here, I delivered pizzas for Domino's Pizza. And I was proud to do it because I needed the cash. There is nothing wrong with that. If you need a second job, go get that. Protect that income, protect your credit. Now, we've been talking about the fact every time I'm in a seminar, people come up to me and say, oh my gosh, we've got these institutional buyers. I'm just having so much trouble. Well, guess what, guys? They're leaving the market. So that segment of the market is wide open. It's going to give every last one of you opportunities that you did not have just 60 days ago. So Open Doors, Zillow, OfferPad, these guys are bringing in their credit lines. They don't want to buy. Now, we've talked about the fact that these guys, when the Mr. Market finally gets a little bit of dip, they're going to take care of our competition. We have seen these industry disruptors before. We saw the Help You Sells, we saw the YUSAs, and they go by the wayside. What this does is reinforce the fact that you need professional real estate people to help you along your line, and this just adds to your quiver of things that you could offer your clients. But it also, these institutional buyers have put a floor underneath the market. They've been gobbling up all the entry-level properties, and they are the greatest flippers in the world. They have just done a wonderful job. I've done business with Open Door. They are excellent at what they do, but they're coming out of the marketplace. So that gives you opportunity to pick up properties that normally they would. So just think of the money that you're going to be making on this. You're just doing very, very well. You're just going to make money on this. So opportunity is knocking right now. So please get out there and try and get some business. Now, you know that when business slows down and the iBuyers leave and you start having turmoil in the marketplace, you know that margins expand. You know you can make better buys in the marketplace. Now, I'm not necessarily a flipper. You know, I'm kind of a buy and hold type of guy. I'm building wealth, but I'm not at all adverse to flipping a property. If you get a good deal and you feel like you want to flip it, by all means, go right ahead and do that. Just be sure that you have enough margin. And as the economy slows down, as turmoil in there, your margins are going to expand. You're actually going to make more money on this because there's going to be more opportunity to choose these. Now, you know I'm a buy and hold type of guy. So I'm more, instead of a buy and flip, I'm kind of a buy, fix, and hold forever and rent these things out. But there's all kinds of ways to do this. So let's not be afraid out there. I think this can be, you guys can just do really, really well. So My plan for you has always been, if you've been coming to my seminars, if you've talked to me privately, you know that, as Dave Ellefson has said, that I would like you to buy in 10 home blocks. I'd like you to buy 10 properties. Typically, I say I want you to buy one house a year, every year for the next 10 years. And of course, sometimes you have better opportunities. Sometimes prices are up. Sometimes their prices are down. We always want to make a smart buy when we buy these things, but we want to buy one property every year and portfolio that. We've been talking about the fact that getting these properties free and clear. So once we get them rented, we want to go ahead and start accelerating paying off that mortgage balance. So we're coming into a buying opportunity. You're coming into a correction in the real estate business, in an ongoing bull market in the real estate business. So you're going to have an opportunity to buy. In the next 18 months, I would like you to start considering accelerating your buying opportunity, because this is a buying opportunity that comes to you about once every 18 and a half years. So in your lifetime, this will be like the third or fourth one that I've seen. The problem and mistake I've made in doing when I get into these market turmoils is I did not buy enough. So I want you to start talking to your mortgage professionals. I want you to start getting your capital together, and I want you to start considering accelerating that buying opportunity and buy 3 properties in the next 12 to 18 months. Now, let's be smart about it. We want to make sure that these fit into our portfolio. We want to make sure that they cash flow. Keep in mind, we have cash flow forms and cash flow charts to make sure that this is a good buy. Just because you can buy a property doesn't necessarily mean that you should buy that property. So we want to make sure we do really, really good buys for ourselves, portfolio these, because we still have a target date of 2023 and 2024. Now, here's one of the theories that I have, and people have asked me, why do you see this happening in 2023, 2024? Well, sometimes when you're doing the cycle work, you can't always do the why. I don't necessarily know why these things are going to happen. I just know that what is going to happen. And on my chart, it shows an explosion in real estate prices in 2023, 2024. But I'm going to tell you, one of the things I've been talking about in my seminars is the fact that the US dollar is going to get stronger. Now, we started around 84, 86 on the Dixie. That's a DXY. That's a dollar index. That DXY is now up over 100. Now, in talking with Walter Zimmerman, he gave me a 103.8 on the DXY 2 years ago, telling me that the U.S. dollar was going to get extremely strong. This is very, very difficult for the world economy when the U.S. dollar gets strong, and you can see it going. You can just look on the charts. You can watch DXY. It got up to 102.8 the other day, so I think we're going to get 103.8. Walter Zimmerman told me that if things got really, really dicey, that the U.S. dollar could get up to 120. Now, a U.S. dollar at 120 on the DXY, we're talking about turmoil in the world. We're talking about real problems in the world. And if things get really tough, we could see that. But let's think this through. If it went from 80s up to over 100, it's just cycling. Everything in the world cycles. And when it cycles up, that means it's probably going to cycle down. And when the US dollar starts cycling down, which is kind of what we're anticipating, if you look at the cycle of the US dollar, we're going to start seeing that US dollar go down. Everything in the world is expressed in US dollars. So oil is expressed in US dollars. Grain is expressed in US dollars. Iron ore is expressed in coal is expressed in US dollars. It's really hard for a coal producer in Australia when their dollar drops down against the US dollar. So if the US dollar goes up 35 or 40%, it means the producer gets that much less. That's really, really hard for them. That's why turmoil is unleashed in the world. For us, that's great. That means that our gasoline gets cheaper. The oil gets cheaper. And if you've all been to Costco, you see that if we're under $2 a gallon, we're probably getting down around $1.50 a gallon. But don't think that this is going to last, because as the US dollar comes down, all of those things are going to start going up in price again. And we've talked about these in my seminars, is the fact that when you start seeing oil go up, aluminum go up, copper go up, lumber go up, concrete go up, what do we make out of all those commodities but U.S. we make the single family homes. And if the components of all those homes start going up, you're going to start seeing prices of homes go up right along with them. So we're going to see a seminal change. This happens every 50 or 60 years where we go from a financial assets to real assets. And we're on that cusp. Now we're at one of the low points, historical low points in real assets, and the fact that we're going to start seeing real assets are going to start gaining in value. So my advice to you, talk again to your financial professional. I'm more than happy to make myself available to you. But it looks to me like we're going to start wanting to buy real assets. We want to buy things. We're going to start seeing natural resources and gold and precious metals and commodities start going up in value. Now, I'm not talking about them tomorrow, but when we look 2 or 3 years, when we're talking about your financial portfolio, we're talking about 2, 3, 4, 5 years out, and we can see that on the charts. So what I want you to do is to start thinking of real assets, and you can start collecting little things. It's accumulate appreciating assets. It's AAA. So do that for us. So I'm going to tell you that I'm going to have my workshop. I have not been doing enough. I know people have been asking me for doing seminars. I'll tell you, I've been very, I'm sorry. It's my fault. I've been awfully busy, but we're going to be doing some seminars. So I will be doing a Creating Wealth workshop. I'll send it all out to you. We'll make it as affordable as we possibly can and make sure that each and every one of you are available to it. Now, I've had some questions that I've just had some incredible questions come in, and they just keep coming in. So Paul Lowe has asked this question about his Canadian investors. Paul Lowe is of course he does he has a Canadian clientele and he manages properties. He's asking, what's the ramification for my Canadian investors? Is this a good time to buy or is this a good time to sell? Well, kudos for you, Paul, to realize that there's a big difference if you're a foreign investor than a non-foreign investor. Now, you're Canadians, that Canadian dollar has dropped like a rock. That's because, as we've been talking, the U.S. dollar has gotten extremely strong. Now, those Canadians that have rentals and investment properties here, they're earning U.S. dollars. So when they repatriate from U.S. to Canada, they get that currency push. So currently it's about 35%. So if they bought a property today, and of course we need to take a look, put our forms on so we cover all our costs. And of course, when we talk about costs, we're talking about management fees. We're talking about cost of sales because typically we have a real estate agent that puts these together. So there's a cost of sales. You know, these things break. We have dishwashers that go out, so we have to put a repair escrow in. And we have typically we have taxes, insurance, and HOA that needs to be paid. We want to make sure all those are paid and we get a return. If we're not getting a return, we have to ask ourselves, what are we buying this for? I'm not going to get any returns. We want to make sure that we get a cash flow on this because that's what makes our day go. So typically when we're talking about getting a property, we're looking to always beat the Bengen rule. So we always want to get at least 4% to 5%. Now that's double, triple what you can get in almost any marketplace in the globe, unless you start taking some really, really risky assets. But when you're talking about a 10-year treasury that's under 1%, and we can get 4 or 5% initially in a rental, why, most people are pretty happy with getting 4 or 5 times what they can get in a treasury. Now, if you're a Canadian investor, that 4 or 5% is going to get an immediate 35% push when you repatriate that back to Canada. So instead of getting $300 a month, you're going to get probably close to $450 just because it's Canadian money. And that translates. So yes, if you pay a little bit extra here in the United States because your dollar is lower, but you're going to be getting a huge, huge return. Now, the other question is this a good time to sell as a Canadian? Well, I think that we have a really, really big a price spike coming in 2 or 3 years. So I'm not a big seller. However, if you have liquidity needs, if you're my age and you say, hey, look at, I want to buy a Lamborghini because I want to drive that around, or a Ferrari. I want to have some fun in my life and I want to sell a couple of properties because I need some liquidity. Or if you just like having some cash around, sure, as a Canadian investor, I couldn't think of a better time. A Canadian investor, If you sell a property here in the United States and then repatriate, you sell a property here for $300,000. Man, you take that back to Canada, you're going to be taking back probably $430,000. So, sure, what a great time for a Canadian to do that. Here again, without knowing the investor or who you are, we want to make sure that that's appropriate for you, of course. And we're more than happy to talk to your financial advisor, talk to your broker, talk to your agent. We're more than happy to sit down and do numbers with you to help you to make that decision. But of course, what a great time for a foreign investor to liquidate a property. They're going to get that currency push. So I hope that answers. I hope that your clients, Paul, will appreciate that. I have another question here from Mark Morlock. Mark is saying, I have clients that are baby boomers, and they're concerned about getting incomes. Well, Mark, that's a really, really good question, because that just piggybacks really well with what just Paul was just saying, is that as we get older, we're starting to need income requirements. And where do you go to get yield? I mean, literally, where do you go? You want to be conservative with your money, because I'm going to tell you, as a baby boomer, we sure as heck don't want to take a chance with our money. We need to be very, very conservative. So here we are in Phoenix, Arizona, probably the #1 market in the world, sitting next door to California. And California, of course, is just melting away. And people are leaving in droves, coming here. So we have organic growth in Maricopa County with all of the people leaving California. They're coming here. They're changing our demographics. And of course, we have kind of a housing pressure because of people coming here. We can't build enough houses. I've been told we have kind of a housing crisis. And if any of you have rentals, or you have any starter homes or entry-level homes, you realize that even though we've had some problems in the economy, people still need a place to live, and there's a lot of pressure on that segment of the marketplace. Now, as a baby boomer, if you're concerned about being in the stock market, you're concerned about being in the bond market, and you want to be conservative, Mark, you've come across what a great idea. Of course, as a baby boomer, you want to be conservative, but you need that income. You've got money, but you need that money to work for you. And yes, of course, here in Maricopa County, I think that we may have some price correction, but there's so much organic growth, I don't think it's going to be terribly, terribly significant. So I think it can be safe, and I think that you can consider bringing your investors and your baby boomers, let them buy a few properties for themselves, and they'll get themselves a nice income. Not only will they get a nice income, but according to our charts, whenever you buy a real estate, this is not a 30-day or 60-day hold. This is typically at least a 4 or 5 year hold. And looking 4 or 5 years down the line, I think not only do they get income all along the ways, but I think they have a nice capital gain pop in 4 or 5 years. So very, 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 very astute. I'm really, really proud of you guys. That was a great one. So I'm getting lots and lots of calls here. I don't know if I can get to all of them. Mark Beauvais is coming in, and Mark has asked a really, really good, astute question, asking about vacation rentals. Pardon me, talking about furnished rentals. And of course, here's something that's really interesting that's happening in our economy. We saw all the baseball stadiums with closed, and then we lost spring training. We lost the theaters. We can't go to the movies, and a lot of the winter visitors went home. They want to shelter in place, and they want to shelter at home. So here we are. Our vacation rentals were sitting vacant. But here's a funny thing that's happened to this: is that people coming into town that they need to work for a month or 6 weeks or 8 weeks. They've got a sabbatical coming here. They need a place to live. They don't want to go to a hotel. The hotels, restaurants closed, the bars closed. They can't even go. They can't go to the pool. They can't visit with anybody. Who wants to stay in a little bedroom and walk back and forth, get your exercise going from the bathroom to the window, back room to the window? And they've gone into furnished rentals. So we've gotten into the fact that we're getting into our furnished rentals are getting demand again. So I think we're taking a lot of that demand that would normally go to a hotel, and they're coming into the furnished rentals. So Mark, I think that they're going to be a terrific, terrific investment for yourself. So listen, guys, thank you very much for this. I want to thank you all for coming on. If you have any kind of questions at all, please give me a call. I think I have just a few minutes. I'm going to flip back through my slides. I do want to go through the very first one and let you see this one and just kind of recap this. So this one right here, this is the most important slide that we have. You can see the two corrections in an ongoing bull market. This is very, very similar to what happened in the early 80s. It was very terrible. That's when I was first cutting my teeth. It scared the bejeebies out of me. I was kind of really concerned. I had no one to tell me any different. But if you see this, we could have a correction. Now keep in mind this is a national chart. So you know that I recently upgraded Las Vegas and Phoenix to neutral. We have not gotten to a buy situation yet, but that buy is coming, and you can see on that chart how in 2023, 2024 we peak. I think what we're going to be looking at is probably a 2005 on steroids. So I'm telling you to pay attention. I don't think that you want to race out right yet and buy a property, but I certainly think that you want to get all your ducks in a row, get your credit in ready, go pre-qualify, get your cash put together, pay off all those bills, because we're going to want to buy. Anyone who has not done well in the past, you're going to have an opportunity to do that. So talk to your clients, talk to your baby boomers, of course. You know, baby boomers are going to want to see this. I'm going to want to see this. I'm going to make myself available for you. If you have any kind of questions at all, any kind of concerns, I am here to give you a hand. Now we're going to be having a seminar. I put together a workbook. Some of you have seen it, and thank you for taking a look at it. And it's going to be pretty simple. It's going to go from zero to wealth. It's going to take someone who's got really nothing. It's just getting going. It's getting started. Maybe you're in debt. You really haven't had any wealth, and it's going to try and solve some of the problems. It's going to try and get some ideas for yourself, and give you a guide so that you can start making some money and get your family safe and secure. So if I can help in any way I possibly can, I certainly will. Please, if you've got an extra $10 or $20 or $100, $200, what a great foundation it is to have a rock star. How would you like to have a rock star teach your 15 or 16-year-old how to play guitar? My God, they'll remember that the rest of their lives. So what a great foundation that is. And if you can help, no problem. And be sure to let me know, because we'll send you an ebook. If you have any kind of questions, just give me a call. You can get me privately. I'm here at West USA for you. So thank you very, very much for logging on to us today. And as always, my very best to you. Bye-bye now.